Welcome back to my YouTube channel. In last lecture we have discussed about comprehensive and uninsured motor vehicles. In this lecture we will carry on with loan or lease payoff coverage, also known as GAP coverage or GAP insurance, was established in the early 1980s to provide protection to consumers based upon buying and market trends. Due to the sharp decline in value immediately following purchase, there is generally a period in which the amount owed on the car loan exceeds the value of the vehicle, which is called upside down or negative equity. Thus, if the vehicle is damaged beyond economical repair at this point, the owner will still owe potentially thousands of dollars on the loan. The escalating price of cars, longer term auto loans, and the increasing popularity of leasing gave birth to GAP protection. GAP waivers provide protection for consumer when a gap exists between the actual value of their vehicle and the amount of the money owed to the bank or leasing company. In many instances, this insurance will also pay the deductible on the primary insurance policy. These policies are often offered at auto dealership as a comparatively low cost add on to the car loan that provides coverage for the duration of the loan. GAP insurance does not always pay off the full loan value, however. In some cases, any unpaid delinquent payments due at the time of loss, payment deferrals or extensions, refinancing of the vehicle's loan after the policy was purchased, late fees, or other administrative fees assessed after loan commencement. Therefore, it is important for a policyholder to understand that they may still owe on the loan even though the gap policy was purchased. Failure to understand this can result in the lender continuing their legal remedies to collect the balance and the potential of damaged credit. Consumers should be aware that a few states, including New York, require lenders of leased cars to include GAP insurance within the cost of lease itself. This means that the monthly price quoted by the dealer must include GAP insurance, whether it is delineated or not. Nevertheless, unscrupulous dealers sometimes prey on unsuspecting individuals by offering them GAP insurance at an additional price on top of monthly payment without mentioning the state's requirement. In addition, some vendors and insurance companies offer what is called total loss coverage. This is similar to ordinary GAP insurance but differs in that instead of paying off the negative equity on a vehicle that is total loss, the policy provides a certain amount, usually up to $5 grand, towards the purchase or lease of a new vehicle. Thus, to some extent, the distinction makes no difference. That is, in either case, the owner receives a certain sum of money. However, in choosing which type of policy to purchase, the owner should consider whether, in case of a total loss, it is more advantageous for him or her to have the policy pay off the negative equity or provide a down payment on a new vehicle. What is vehicle towing coverage? It is also known as roadside assistance coverage. Traditionally, automobile insurance companies have agreed to only pay for the cost of a tow that is related to an accident that is covered under the automobile policy of insurance. This had left a gap in coverage for tows that are related to mechanical breakdowns, flat tires, and gas outages. To fill that void, insurance companies started to offer the car towing coverage, which pays for a non accident related tows. And now we will move on to personal property. Personal items in a vehicle that are damaged due to an accident typically are not covered under the auto insurance policy. Any type of property that is not attached to the vehicle should be claimed under a home insurance or renter's insurance policy.